The Brexit housing market. In this video, I'm going to share with you how Brexit property market uncertainty will affect UK house prices. I'm going to share with you who the winners and losers will be in the property market from all this uncertainty. And thirdly, I'm going to share with you how savvy investors will be exploiting these unique market conditions to profit from all this uncertainty. That's all coming up. My name's Ranjan. I've been investing in property for more than 30 years. I've invested through thick and thin, through all phases of the property market cycle. What I see happening now is pretty much rinse and repeat of what we have seen in previous market cycles. That's all coming up. If you're new to this channel, make sure you subscribe. We release new content each and every week, and it's all dedicated to helping you become a more successful property investor. So how has Brexit uncertainty affected UK house prices? Well, this isn't going to be a political rant about in, out, shake it all about and all that sort of stuff. What I'm going to talk about is uncertainty. Ever since this referendum happened in 2016, the housing market has been paralyzed by this state of uncertainty. It's uncertain because what's happening, and this has got worse and worse and worse as the sort of political farce has just continued, is that if you're looking to sell a property and you don't have to, then you will delay that sale. Why? Because you're expecting that you'll sell it, you can sell the property in a few years' time and you'll be able to sell it in a better market. If you're a buyer, you are fearful that what you buy now might be worth slightly less in a couple of years' time. So if you can hold off from buying, a lot of buyers are delaying that purchase. So what you've got is a market with a lot less transactional activity happening. It is people who have to sell and people who have to buy who are active in today's property market. Now, how do I know this? Well, property auctions are and have always been a barometer of what's happening in the property market. What happens in the property auction room today is a sign of what's going to happen in the general housing market in a few months' time. What we've seen in the fall of 2019, if you look at property auction sales results, we've seen the sales data, the percentage of properties sold at auction being at the lowest levels that we've seen in recent years. I've seen some big auction houses with sales ratios in the 60%. When just a couple of years ago, they were selling 80 to 90% of everything that was put up at auction. So that's a sign that buyers are nervous, sellers are nervous, and this is feeding into the general housing market. So we all know that the property market operates in cycles. These can be long cycles of many decades, but they go through periods of boom and they go through periods of bust. They go through periods of exuberance and the market getting carried away, and they go through periods of pessimism, and that tends to be overdone as well when there are bargains to be had. Now, the things that causes a market to top out or bottom out are different with every single cycle and are very hard to predict. But what happens when the market moves from one phase in the cycle to the next is very, very predictable. So we are now at the stage where the market has topped out. The causes of this topping out is Brexit uncertainty. And what we're going to see now over the next few years is pretty much near identical conditions that existed in 2009 up until 2014. Back in 2009, the trigger for the housing market coming off its peak was, of course, the Lehman Brothers crash. This time round, what's knocked it off its peak is Brexit uncertainty. Now, it doesn't matter what's happening with Brexit. The property market is like an oil supertanker. It takes months, if not years, for it to change direction. The uncertainty, the prolonged political uncertainty that we have had around Brexit has already done the damage to the housing market, has already caused it to peak, has already caused it to go into that recessionary phase. The experts predict falls over the next few years of anywhere between 8 and 12%. Now, I agree with that. I think there will be a fall, and it won't be that much. It will be around those figures. One of the main reasons for that is because this time round, it's not property price affordability that will be the trigger that will cause a massive recession. Interest rates are going to stay low. They have to stay low if we're going to have any form of economic recovery, no matter what Brexit does. So for that reason, the actual falls will be relatively low. But that still bodes a very important question. If you're going to buy property today, then why should you bother if it's going to fall in the immediate future? Well, that's all coming up. I'm going to answer that question specifically later on in this video. So, from all this Brexit uncertainty, who will be the winners and losers? And these are people who are just not recognizing any of the changes in the market, who are just carrying on implementing the same old strategies that worked for them in the previous few years. So who are the losers, first of all? Well, losers are what I call momentum investors. In a boom time, there are plenty of people who jump on the property bandwagon, and they know that the house prices are galloping ahead by a certain percentage each and every year. And they ride that momentum. So they're a little bit lazy about doing their figures, because they know that if their development project takes 2 years, then natural momentum in the housing market, growth of 5-6% every year, will get them out of jail, as it were. So momentum investors who haven't done their figures properly will be big losers this time round. Feeding into that, developers. If you're developing a property and you've only got one exit, and that exit is by sale of your units, you could be in trouble. If you don't have a plan B for your development project, and your property development is taking 1 or 2 years, then you don't know what the housing market is going to be like at the time that your units are ready for sale. It's going to particularly affect developers who are doing high-priced or premium-end developments, because the units that sell best in recessionary times tend to be starter homes for people at the first rung of the housing ladder. The other unique thing about Brexit is what the currency is going to do. We saw when in 2016, when the referendum was announced, the pound fell by 25-30%. I had a couple of property developments going on at that time, and if you were approaching second fix of the development, that's when you start to put in all your second fix equipment, so your lights and your baths and kitchens and all of that, they go into the property, and tiles and wood floors or whatever it is that you're putting into your development. Now remember, most of those goods are imported. So if the pound goes along and crashes by 25-30%, that's just put up the cost that you're going to have to pay to finish your development. So when you're doing developments with a long planning horizon, you don't know what the end sale price is going to be of those units, because the market is moving. The market is very, very unforgiving of high-priced premium development, so you've got to be developing starter homes. And with Brexit, you don't know what the pound is going to do. So it's going to be very, very hard to predict and account for your material costs, particularly as most of them are imported. And to top it all, if your exit from your development is just through selling on, and you don't have a strategy to keep it and rent it, then you could be well stuffed. Of course, other losers will include off-plan investors. I mean, I don't advise anyone to buy off-plan from a developer for investment purposes. If you're investing as a property business, you should be buying sites with development potential. The problem with buying property off a developer is the clue's in the name of who you're buying it from. The developer has already exploited every square foot of that piece of real estate to maximize the potential on it. So you're buying at full value, and basically there's nothing left on the table for you. So off-plan investors will be in trouble. And this is a phase where anyone that's been shoddy with their numbers will be in trouble. If you have planned any property development project or refurbishment project, and you have based all your figures on the best outcome scenario, the best rental values, the best sale prices, the cheapest development costs, and that is the only scenario that you've done, and you've been exceptionally optimistic, then you'll come a cropper. Another loser will be people who have done development projects and they've done all their numbers based on the best case, most optimistic scenario. If you've done all your figures based on the most optimistic sale price, the cheapest development build cost, the most optimistic rental assessment, and that's the only scenario you've planned for, you can be stuffed. Also, of course, existing landlords and property investors with property portfolios in their own name. If you've got properties in your own name, then you're going to be hit by the Section 24 tax grab. That's this tax on mortgage interest. We've got some videos, I'll put some links up here of videos that we've been made on that subject. This is a tax that's ratcheting up over the years, and if you haven't already done so, you need to plan to mitigate your portfolio against this tax. That's going to put you in the best position going forward to capitalize from the opportunities that all this uncertainty is going to present in the marketplace coming up. You know, if you're over-leveraged, it won't be a great time for you in the next few years. My advice would be, and don't think about leverage on individual properties. Think of leverage, how much debt you're carrying across your entire investment portfolio. I would say you want to go into the next few years at around 65% loan to value across all your investment properties to be absolutely surefire safe, if you like, that you're going to come out the other end smelling of roses. You know, this is a time when you're going to have to focus on cash flow. If you've got low cash flow generating properties, that ain't good. Cash flow is going to be the fuel behind your business to take it through these few years. You know, serviced accommodation, I don't think it's the right strategy for the next few years. And let me tell you why. We're going to go through a little bit of a recession, and what happens in every single recession we've ever had, hotel room rates go down. Now, the big hotel chains are well placed to weather this. All they do is they will reduce the price of hotel room rates. So, if you're out there providing serviced accommodation in a marketplace where hotel rates are cheaper, you're going to find that you might not be able to compete in the same way that you managed in the boom years. The other losers in this phase will be the ones who try to wait and time the bottom of the market. You know what? It's absolutely impossible to time the bottom of the market. The thing to do is to recognize that the market's off its peak. When the market's off the peak, it doesn't actually matter when you pile in, as long as you pile in the right way, it'll be a golden time. And I'll come on to that in the third chapter of this video, which will be on the investment strategies you need to follow. Who will be the winners during this period? Well, you don't want to be over-leveraged, as I mentioned before. Those people with 65% or less gearing across their existing portfolios, people that generate good, healthy cash flows. Now's the time to have a think about what can you do to increase the cash flow across your existing property portfolio. Those who are operating their businesses professionally as a property business, those who have factored in Section 24 and implemented mitigation strategies like incorporating their portfolios so that they're ready for the times ahead. All these sort of people will be winners. It's very important, if you've got existing properties, to maintain them well. If you maintain them well, you get premium rents, you'll lessen your voids, you'll attract good tenants, they'll pose you less hassle, and you'll in the end make better, healthier, stronger cash flows. And finally, we're going to look at what's the best strategy to follow in these next few years in the property market cycle. Let me share with you two pieces of research from Savills. The first piece of research they put out was that in 2019, the housing market is more uncertain and has never been at a lower point than since 2009. And that's a very interesting date indeed, because 2009 was just after the Lehman's crash, when the housing market did go through a dip and into a recessionary phase. The second piece of research, also from Savills, says that over the last 30 years, the best time to have bought property was between the periods 2009 to 2014. Why is that? Well, I've got a graphic on screen now, and it shows a straight line. And the straight line is the long-term average house price growth over time. It goes up. But it doesn't actually do that. I mean, that's the average, of course. What happens is it goes up and down in cycles. So there are periods where property price growth is above the long-term average, and there are periods where it's below the long-term average. You can see from the graph that in 2009 we'd peaked, the great credit crunch happened and all of that. That caused us to go into a housing market recession, and that created this buying opportunity between 2009 and pretty much early on in 2014, where property prices were below the long-term average line. Now, I've got a simple strategy, folks. When the housing market is below the long-term average line, that's the time to fill your boots. And it's about filling your boots with the right assets. Now, you know that when you're in a dip phase, that if you buy at market value today, whatever you're buying is going to be worth slightly less in a couple of years' time. Now, I'd say that whatever you buy today is going to be worth 8–10% less. So here's the thing. This is what you've got to do. You've got to make sure that whatever you buy, you're buying from motivated sellers. You're buying shabby property that can be done up. You're buying properties with development potential, where you can add significant value. And you're looking to buy those properties below market value. So if I buy a property and I'm aiming to buy it from a motivated seller, 30–40% below market value, I'm not bothered if there's going to be a slight fall in the market of between 8–10%. So this is an opportunity to fill your boots, because as Saville said about 2009 to 2014, you can see from this graphic again that if you think about it, it's logical. When the property market goes through a recessionary phase, if you buy any time on the down, then you've got the shortest time span between then and the next upward cycle, if you like. Timing is everything. If you buy at the peak, then you've got to wait a long time before property prices significantly improve from that peak level. But if you get the timing right and buy in a dip, you don't have to wait that long before you add significant capital value to whatever you buy. What I find when I look at my own portfolio and I look at other investors who've been very successful getting the timing right, the deals they do in these recessionary periods, the deals they do when the average property price is below the long-term average line, these are the deals that really set you up for life. And these are the deals that are quite hard to replicate in terms of the figures and the bottom line effect that they have in boom time. So this is the time when you need to be thinking about filling your boots. As I mentioned before, the property market ain't going to do anything for you. So what you've got to do is buy assets where you can add value to them, add serious value to them in as quick time as possible. Now, the easiest game in town to add value to property is through permitted development. Permitted development, as opposed to planning permission, is much, much better. The problem with planning permission, and I mentioned this on other videos, I'll put some links up. With planning permission, it's completely uncertain. You know, it might take you 3 months, it might take you 3 years to get permission on a particular scheme. The great thing with permitted development is where the government is actually saying you are permitted to carry out XYZ types of developments on this property. And that means you can buy a site and develop it with certainty that you're going to get the permission to do what you want to do. And that's very powerful indeed, because uncertainty is costly and you don't want that. Now, the best game in town for permitted development is commercial property. The most permitted development rights are offered with commercial property, because commercial property is going through massive change right now. The internet has changed the way everyone is doing business, and that's made a whole bunch of commercial buildings defunct for their existing uses. Whether you're looking at retail units, whether you're looking at office spaces, like this one for example, or whether you're looking at light industrial or warehouse changes, the way businesses are being done has changed dramatically, and the government recognizes this. So they've brought in and are continuing to bring in a whole raft of permitted development rights, which allow developers to repurpose commercial buildings to other uses. This may be repurposing those buildings for residential usages. It may be repurposing those buildings for other commercial usages. I've got some videos that we've done on this subject right here. Now, the great advantage of those is that if you buy sites well, you're buying them from motivated sellers, you're buying them below market value, say 30–40% below market value, plus you're buying commercial sites where you can exploit easily realizable building potential. By exploiting permitted development rights, what you're doing is adding significant value to a site regardless of what the property market is doing. Let's put it this way. I mean, it doesn't need a rocket scientist to figure out that if you've got a commercial building and under permitted development, you could get permission to, say, replace it with 3 flats. It doesn't take a rocket scientist to figure out that you are adding significant value, and you're doing that in the space of just a few months, irrespective of what the property market is doing. That's a real golden opportunity for now. And again, because you're doing this activity in a trough, you're only going to have to wait a maximum of 8 to 10 years before the market is in its boom time again. And because of that differential I showed you on the graph before when I had the graphic up, you don't have to wait that long before you've experienced significant capital appreciation. That's pretty much my blueprint for over the next few years. It worked a treat for everyone that followed it between 2009 to 2014. And if you look at the indicators, we've got exactly the same conditions going into 2020 because of all this Brexit market uncertainty. If you want to find out more about commercial property investing, doing commercial property buy-to-let, doing repurposing of commercial buildings using permitted development, and also using your pension to invest in a very savvy way in commercial property. I run some workshops, a weekend workshop on commercial property investing. You can find out all about that in the links below. If you've got any comments, let us know in the description. I'm happy to discuss any points that you may agree with or disagree with. So let's have a little bit of a discussion down there. And remember, like, subscribe. We put out new content every week. See you guys in the next video. If you enjoyed this video, hit the like button. If you're not a subscriber, what are you waiting for? Subscribe, hit the bell icon. As soon as we upload, we'll let you know. And enjoy these. They're all dedicated to helping you be more successful in property. Happy investing.